Welcome to Talking Property. Today we're joined by SQM researchers Louis Christopher as we preview the second half of the 2024 Sydney property market. Louis, thanks for joining us again.
Good to be with you once again.
Louis, much to happen in the second half of 2024 in terms of events, both locally and globally. If I can bring up our first slide.
Yes.
We're going to see US election.
Yes.
We're going to see UK election for that matter.
Yeah.
The geopolitical space looks increasingly fragile.
That's right.
We've got Russian warships in Cuba now, which is keeping it very spicy and interesting. Mm-hmm. Inflation in Australia has been trending up throughout the first half of the year. Unemployment has edged up, although there was a pretty good number today that suggests that it's not rapidly rising and it's decreased subtly, but there is some employment issues out there. Australians get a tax cut in the second half of the year. The interest rate outlook is uncertain, and housing demand, both for sales and rentals from immigration demand, is very strong. So how does all this play out in the second half of 2024?
Well, that all represents mixed forces. Some
Yes.
negative forces there for the economy, some positive ones as well. I think the key number to watch going forward as we head deeper into the later half of 2024 is unemployment. If we were to see an aggressive rise in unemployment, I think that potentially could tip the RBA's hand to a rate cut sooner rather than later. Of course, the other offsetting force there is inflation. And of late, we've been having some more negative reads on inflation, which would suggest that the RBA is really struggling to get the inflation rate back to 2 to 3%. Now, we continue to have more negative reads that'll at least put the RBA on hold for the rest of the year, or still create the possibility of a rate rise. It's a very difficult situation right now to be a central banker.
Because there is a number of credible analysts that believe inflation globally will come back in the second half of 2024, aren't there? There
is a risk of that, that's right.
Yeah.
And we've been concerned about that scenario playing out as well. And what could drive that scenario, as you've just pointed out before, is yet more increased geopolitical tensions around the world. To the point where you could see potentially embargoes on oil play out there, embargoes placed on other raw materials and on food. That's what kind of drove the inflation rate to begin with when we had the 2022 outbreak of the Ukraine-Russian war. That remains to be seen, of course, what actually happens there, but it's definitely been simmering like I've never seen in my life in terms of these geopolitical tensions. So with that type of environment, anything can happen.
Yeah, indeed. And oil was the catalyst for the major inflationary outbreak in the 70s, wasn't it?
Absolutely,
oil
it was.
Plays a phenomenal role in how our economy functions.
It is definitely a key risk.
Yeah.
Now, of course, we had in more recent months Israel and Iran fire missiles at each other, and I was deeply concerned when we had that. I thought, okay, the next move will be some type of embargo driven by Iran. That didn't seem to play out. I found it quite interesting that it seemed as though both sides blinked for a little while. They both bided for time.
Do we really want to do this?
Do we want to do this now?
Yeah.
I think it's more, do we want to do this now?
Right.
And I think both sides realised they didn't want to do this right now.
Yeah.
But let's not forget they're both adversaries. They really do not like each other. I still have some deep concerns that could still flare up again.
It would be terrible if it does, but yeah, I think it's a live issue, there's no doubt.
It is.
So what you've defaulted to there in talking about the domestic Sydney property market is it will be very, very much governed by global events, in your view, in the second half of the year.
It'll be governed by global events. It'll be governed again by what actually does happen with migration. Do we actually hit the budgeted numbers from the federal government, or do the numbers come in higher than expected once again? It'll be governed by what the RBA does with interest rates. No question about that. We already know one missing piece of the pie, and that is, of course, building approvals. We're going to be under building again for the whole year, and that will keep the pressure on the rental market, notwithstanding some seasonal lulls that we've recently discussed.
Louis, I just want to test your economic thinking and the conventional theory about managing inflation for you. I saw an analyst giving some analysis yesterday talking about shipping rates have gone up pretty sharply in the last three months, I think.
Yeah, that's right.
I think she said, and that will feed into inflation in the second half of the year.
That's measured by the Baltic Dry Index. And so what's causing that is that a lot of shipping now are not going through the Suez Canal, okay, because they're trying to avoid all the trouble that's occurring in the Middle East, and that means that they're having to sail around Africa. That, of course, incurs more costs, more fuel costs, for example, for the shippers.
So I sat there watching that, and I accept the reasoning as to why shipping costs have gone up, and it is the geopolitical event.
Yes.
But I did sit there thinking the person that's sitting at home and their household budget is cash flow negative, or they're living off savings to get by, or they're cash flow neutral, and they're sitting there asking themselves, how does putting interest rates up on me help the shipping costs, and where's the fairness and where's the solution in all of that?
It's a fair point, and I could understand why most people would think that's rather unfair, because we're talking about forces beyond this country's control.
Yes.
Right? But there is one force there which the RBA feels that they can control, and that is a wages spiral. So the average person there, of course, as you mentioned, is getting squeezed, right, by higher costs. What can they do to alleviate that? Well, they can go to their employer and ask for an even bigger wage rise. And to an extent, we did see that over the course of 2023 and earlier 2024. What the RBA is trying to do is reduce those pressures upon employers for those wage rises, because all employers will do in this environment is pass on those costs, which creates a spiral in inflation.
And you see that everywhere you turn in the everyday economy, don't you?
Absolutely you do. Yeah. Notwithstanding some real pressures out there on shop fronts themselves, where they've been getting squeezed by higher rents, but there hasn't been a lot of demand, particularly in the inner city areas where we've still got a work from home mentality in many respects. Very hard for cafe owners to pass on costs.
Let's talk a little bit more about the RBA, because as we know, over the last few years, they've really been beaten up on their position.
Yes.
But one of the points that's really interested me in recent times is the RBA's cash rate.
Yes.
Is in terms of the developed world, is one of the lowest.
Yes, that's right.
Europe's at the bottom there, but we must point out that Europe cut their rates in early June.
Yes.
To bring their rate under Australia's. Now, the only other major economy there that I think is worth pointing out that's not on that list is South Korea, which are in the 3s.
Yeah.
But most of the developed world have actually got a higher cash rate than Australia. And if we go back to, I think that the two last rate hikes were last November and last July, is that right?
Yes.
June or July. And the RBA were absolutely slated for increasing interest rates on both occasions. But now you look at it where we do actually have the strongest inflationary pressures in our economy across the world than most others across the world. And you ask yourself, well, what if the RBA didn't increase interest rates last July and or last November?
If they didn't, we would have had inflation running at 10%. Easy.
Easy, yeah. So they're actually doing a pretty good job, aren't they, in terms of the actual purist policy position?
I think they've been improving their game since the new governor came on board. Look, it's an extraordinarily difficult job to get right. There's a lot of political pressure, there's a lot of public pressure, no question. Going to these rates, it is interesting that we've got a cash rate below many of our economic major partners. Now, one could argue that perhaps the rate should be higher, because in many of these partners, the inflation rate is now lower than what we have. For example, the US now running at 2.7%.
Massive point is that they've got higher interest rate settings and lower inflation.
That's exactly right. So they're running what's called a higher real positive cash rate compared to us, where our real positive rate is still just above zero. So what that should mean for the United States is that we should see a material slowdown in their economy over the course of the next 6 months. But of course, let's remember that the budget deficit in the United States is a lot greater than what we run here, both in terms of absolute dollars and proportionately as a percentage of GDP. So the Federal Reserve's been fighting that off, okay? So the government there, the Biden administration, has been stimulating the economy with these massive budget deficits. Okay, here going back to Australia, we're running more of a balanced budget. Okay, so there's less pressure on the RBA to offset the stimulation coming from a federal government than what we see in the United States, and indeed with a number of these other countries as well.
Our government's working more in lockstep with the central bank than what they might be in America, where it's
absolutely
1 foot on the accelerator, 1 foot on the brake, so to speak.
That's correct, and it's the same case with Europe. Europe's not running a balanced budget, they're running a budget deficit.
Coming out of the budget, did you buy into the notion that the budget was inflationary?
No, I thought it was more neutral than anything else. We need to watch out for these tax cuts, not that I think they're going to be massively stimulatory, but overall, I mean, it was actually a budget slightly in surplus, no question about that. The forecast is that it will go back into deficit again, and perhaps the timing of that deficit might be okay, especially if we're having a slowdown in the economy.
So we expect for the foreseeable future that interest rates will be on hold.
Yes.
Putting all that into the mix, if they cut rates and if they increase rates in the second half of 2024, what happens to the housing market in both of those instances?
Yeah, good question. If they cut rates, it should stimulate the housing market unless we are already in a deep recession. So one rate cut might not do much at all if we're seeing material rises in unemployment. If they lift rates, it's because the inflationary numbers are worse than expected and they need to try and cool the economy down some more to reduce the price growth that's occurring. Now, if you do see an economy like that, a stagflationary economy, now, funnily enough, housing historically has been a good hedge against inflation. So it's still possible, even with a rate rise, that you would see higher housing prices in this country, driven by a wage spiral, effectively, and more people still coming in, more wealthy people coming into the country and buying homes.
And that sets up a scenario where those that are under duress can refinance against newfound equity in their property and continue on with their existing lifestyle?
Potentially, but what you could also see is a situation where you see a lot of distressed activity out there, but it's absorbed by new buyers in the marketplace.
Yeah, and that's a healthy, functioning market if that were to happen, wouldn't it?
Yes, but it's not a pleasant situation for existing property owners who are forced to sell.
Yeah, but if you are unfortunately forced to sell, if you are going out to the market that'll absorb the offering.
Better than having no market at all.
Yeah, indeed, because that's where you can see rapid price de-escalation if there's no demand to meet some surge in supply.
You know, Peter, one thing I do say to our audience is that there's one thing that's missing in our housing market which would create a housing crash. So if you consider all the housing crashes which have occurred across the world, in Japan, in Ireland, in the United States, the ingredient which was common to all three of those cyclical crashes was an oversupply of real estate.
Yes.
Overbuilding. We don't have that in this country. By all means, we're massively
underbuilding.
We're on the
opposite end of the spectrum.
So if you had a situation where we go into recession, okay, and let's say that's driven by another rate rise. Now, I think you might well see housing price falls in that scenario, but would you see a 20% down year or more across the country? I don't think you would see that.
Let's go to housing supply, because that is one of Chris Minns' big ticket items here. If we can bring up our next slide. Chris Minns and his government have a very firm desire to build up in the inner city, not further out in the suburbs.
Yes.
And we see headlines like this here now. If we go back to the former state government, the Liberal government, the messaging that he has around housing, they had around infrastructure.
Yes.
But it took until very late in the first term and well into the second term before we saw their plans on infrastructure beginning to come to fruition. Now, most people in Sydney did want to see better roads, more tunnels, metro stations, etc. So the public were accommodating and very much behind that state government's efforts on infrastructure.
Yes.
This is a more vexed issue, because if Chris Minns' agenda gets up, it will very much change Sydney forever, in my view. I don't know what your view is, but Sydney won't be the same if he gets these density programs up in the inner city that he's pushing for, drawing circles on maps saying they're now high rise or medium density. When will we see his plan coming to fruition?
Well, if it does come to fruition,
Yeah.
of course. Look, there is a lot of pushback, especially from those who want to see more supply, but not in my backyard. And this is the critical issue right now. I think that's a smart way of doing it in terms of building in inner city locations. The notion of building along railway lines is not a bad idea, but what about building over railway lines, for example?
Yep.
That's a smarter idea because you're impacting less of existing residences that are out there. The areas, of course, we are aware of the lower and upper North Shore in particular, where there's going to be a lot of building there. And those seats are held by Tills and a couple of Liberals there, which I note the Liberals in particular are pushing back on. I think inevitably we will see more high density building in the city of Sydney. I think it's inevitable over the long term, and it'll be driven by ongoing population growth towards this city. I would personally like to see more activity in regional Australia, and I think our future lies in regional townships. Just like how the United States was successful in the 20th century and the 19th century, or the later half of the 19th century, in terms of building its wealth. They did it through regional townships, inland cities, townships that turns into cities. And we have that opportunity here over the long, long term. But in the meantime, Sydney will continue expanding on the fringes as much as it can, notwithstanding we are in a basin. We're expecting outperformance over the long term for Sydney in the outer regional areas. I think the Blue Mountains will be an area where we can see some outperformance over the long term.
North Wollongong,
Central Wollongong, the Central Coast, they've already been performing.
Been strong.
And I think that will continue over the next 5 to 10 years. Will we see a cycle where we get an oversupply at some point? Yeah, I think it will. I think this is a long-term cycle we're in. We're in the trough in terms of underbuilding, and governments are making all the noises to suggest that they want to really try and drive up building. Eventually they will be successful, and if they're not, they're going to get booted out because the housing rental crisis is front and centre of the electorate right now. We're not going to see a lot of building in inner city over the next 2 years, but I think over the next 3 to 5 years, I think the present state government's more likely than not to win out in terms of what they want to see.
Pitching apartments versus houses, and townhouses sort of sit in the middle there, the medium density. Does that mean that a house becomes a better long-term buy because it's very hard to build new housing in the inner city versus it's much easier to build apartments in the sky?
Well, that's
does that
really interesting. I did a piece of research, which I think I did put up on Twitter recently, in terms of what's been the capital growth of houses versus units so far in the 21st century for Sydney. Okay, just looking at the capital growth, and if I recall the number, Sydney houses came in somewhere around 7% per annum, just a little bit over 7% per annum. Sydney units came in at about 5% per annum, if I recall the numbers. I might publish it again. But those numbers didn't take into account rental yields.
Yes.
And when you actually take into account rental yields, as you would be well aware, units rent higher than houses. So when you look at the total return, taking into account rents, the two asset classes perform in line with each other.
Interesting. The other one I'd throw over the top of that is holding costs, where with apartments you have strata levies you don't have on a house. Not for every investor, but a lot of investors now know, I don't need to tell them that they're getting hit with land tax.
That's right.
That you're less likely to be hit with on an apartment.
On an apartment, that's right, because you're sitting under less land.
Yeah. So you bring me to the next point I wanted to cover with you today. I want to talk about one postcode specifically, but I think there's a lesson in this postcode. And that's postcode 2046, which is Rod Point, Marimba, Chiswick, Abbotsford, 5 Dock.
Right.
Largely speaking.
You know that area very well.
Yeah, and indeed. And beautiful 1920s Californian bungalows right through that entire precinct.
Yes.
The council has allowed, in the last decade, those Californian bungalows to be pushed over. They don't consider them significant heritage or conservation zone. And private residences and developers have got hold of these 500 square metre blocks, some of them are 700 square metres, and built either really modern, substantially larger duplexes on them or magnificent architectural designed homes.
Yes.
So if one looks at a graph, the 2046 postcode has absolutely skyrocketed in price,
Yes.
in median price, average price, whatever
Yes.
metric one chooses to follow.
Yes.
But it's got there by having a materially different type of dwelling that's far more expensive to build than it is to keep the humble Californian bungalow in place. So how is that captured or reconciled in the numbers? Another way of explaining this, you'll often hear about a celebrity buying a house for $5 million and selling it for $9 million, and everyone says, what a genius. And you sit there going, yeah, but when does the $3 million in renovation costs get factored in?
It doesn't. Okay, so yes, when you look at house price indices, number one, you cannot really take into account renovation costs. That's true, and indeed, of course, you cannot take into account interest expense costs as well. In terms of how we put together our indices, we do it based on strata versus non-strata. Anything non-strata we classify under houses, anything strata we classify under units. What you talk about there is something which I think does suggest that in the inner ring of Sydney, and I'd say now the middle ring of Sydney, because I'm seeing it in the middle northwest of Sydney around Carlingford.
Yes, Ryde.
Ryde, where a lot of these duplexes are going up, is that there is an opportunity to buy these homes, knock them down, subdivide, turn them into semis, because the price per square metre one can get on, say, a unit or a semi is far, far higher than the price per square metre on a house and land. So there is this subdivision opportunity that you see in the marketplace. And indeed, it's not just in your area, it's across Australia you see that to various magnitudes. We actually have this all mapped out for free on our website, where people can look it up and see.
And the website is?
Well, sqmresearch.com.au, thank you, Peter. So it is a very interesting phenomenon that you see there. Now, of course, one needs to take into account building costs when you look at doing this, but on a purely opportunist investment play, there are certainly opportunities around Sydney to buy these homes, subdivide them, turn them into semis, and you will make a profit.
Yeah, there's a lot of people turning them over that way, isn't there?
There is indeed.
Yeah.
But yes, I agree with you, the notion that, look, how is that reflected in the price? Well, it's not, you cannot adjust for that in median housing price indices.
That's right, and I think anyone that is looking to do a renovation, a flipper, and they're going into it for the first time, really need to be conscious of net proceeds, net profit.
Net proceeds are
gross
critical.
profit.
Put it this way, building costs are not coming down.
You don't see that happening?
The builders, as we've discussed recently, have been struggling big time. Now, their raw material costs have come down following the falls in lumber prices and so forth, but their labour costs are up. And so they're still getting squeezed. So I've noted that, building costs have skyrocketed. To do a renovation in Sydney, it's a lot of money now, just to do a standard renovation. And yes, you really do need to do your numbers before you go ahead to make sure that you are going to make a profit, particularly if we are heading into a softer market.
During COVID, I don't like to go back to COVID too often, but there was a renovation or a home improvement boom.
Yes.
People felt that was the right time to do up the kitchen, the bathroom, whatever it may be.
Yeah.
Have we got a sense of how home improvements are running at the moment? Has that
They've fallen off a cliff.
Fallen off a cliff.
In my view, from what I can see through the data,
yes.
they've fallen off a cliff. So hardly any renovations are taking place. There are some, there will always be some, but it's well and truly off the highs that we had back in 22 and 21.
Yeah, great. Louis, what do you think will be the best performer closing out the year for Sydney property?
Lower to middle end units
Yes.
is my bet, because there is still a lot of rental demand.
With low strata levies?
Yes.
No elevators?
No elevators,
concierge.
it's your stock standard units.
Yep.
Still being driven by fairly strong population growth, even if the federal budget numbers do come into play, which I think they're undercooking it a little in terms of what the final number will be on migration. provided the Sydney economy holds and doesn't go into any type of material recession, the very top end of the market will likely outperform as well. So these are properties, of course, bought by cash buyers, your $10 million plus properties, right?
Yes.
But as also mentioned recently, your $2 to $5 million range, I think, is going to underperform. These are, of course, owned and bought by employees still, who are doing it on a stretch, big time. And the elevated interest rate environment, which is still with us, of course, has impacted that demographic.
Are you across those numbers coming out of PEXA that 30% of all transactions are mortgage free?
Wow, no, I wasn't aware that there was actually that high of late.
Yeah.
Very, very interesting.
Now, and that's down the eastern seaboard. That's
Yeah.
not, an upper end of the Sydney property market.
Yes.
That's up and down the eastern seaboard, and
Yeah.
they're crediting that with baby boomers that are downsizing and what they
I
buy.
wouldn't be surprised by that.
Yeah, that's driving it. But that's a pretty interesting point and shows you why the market has been so resilient towards interest rate hikes over the last 2 years.
Absolutely, that is correct. But it's 70% of the market then is still bought with finance.
Yes, indeed.
So, if interest rates go too high or we see a rise in employment, you will see a rise in forced selling activity relative to overall demand.
I think the other thing that may not be captured in the data, but we do see on the ground, is mum and dad sell the family home.
Yep.
They buy themselves a new, cheaper property. They put some into super, but then there's a chunk of change that goes towards the kids to get into the property market, the bank of mum and dad.
I think particularly in and around Sydney, most first-home buyers are relying on the bank of mum and dad now. That's just the reality on the ground.
It's a big force in the market, isn't it?
Absolutely, it is.
And the reality there, if you're looking at this widening gap between the haves and the have-nots, is the better off families are able to give their children a head start, which is a clear advantage in this environment, isn't it?
Yes, it is.
Yeah.
That's the concern you have with elevated housing prices, is that it can create a lot of social friction.
Yeah. Have you ever seen the wealth gap as wide as what it is now in Australia?
Not in Australia, no.
Yeah, it's alarming.
Now, let's not overly play this up. Let's keep in mind on the last update from the ABS how overall housing ownership rates actually held stable. Not many people talk about that, but it came in at about 63, 64%, if I recall the number. And that was stable compared to the previous census numbers.
That's good. Yeah.
So we're fortunate enough that the majority of adults do actually own their home, which helps. But yes, given our underbuilding that we've been seeing, given the fact I think tenants are staying tenants for longer, which has also been creating pressure on the rental market, the probabilities of a fall in home ownership rates have increased again. And then you do have that real situation of haves versus have-nots.
That's a subtle point you've mentioned there, but I'll just excise it. When the rental market rises the way it does, the first home buyer that's renting and saving for a deposit tips the deposit money back in on the extra rent, don't they?
Yeah, they have to.
Yeah.
That's exactly right.
That is the tragedy, the true tragedy of where the rental market has gone.
Yeah.
Is it is consigning a generation to potentially being lifetime renters.
That's exactly right. And that's why, we do need to increase supply. Even if migration levels stabled out, we still need to increase supply.
Yeah.
Okay.
Yep.
Yeah.
Louis, off-property question, and we'll close on this. Who wins the US election?
Trump, no question, unless it's rigged.
Unless it's rigged.
Unless it's rigged. I don't play into that too much, but I think Trump will absolutely trump it.
Do you think Trump will face Biden?
Yep, I do.
Yeah, so the Democrats will...
I think it's too late now to change the presidency unless Biden ends up in hospital, something like that, and he bails out because of it. But I think it'll be Trump versus Biden.
I think Biden will get rotated out.
Wow, yep. You still think there's time to do that?
Yeah, at the convention. I think they'll wipe the ticket, so he and Kamala will go out. And I think the winner will be the party that leaks the least votes to RFK.
Right, yes, and that is a factor. And RFK has certainly been out there in social media, and he's got his fans, that's for sure.
Oh, he's got a following.
Yeah.
It's an interesting dynamic.
Yeah.
No need to discuss the UK election. I think that's all but done and dusted. Louis, thanks for your time today.
Thank you, Peter.
And thank you for joining us on Talking Property. We look forward to speaking with you next time later in the year.